Good afternoon. Thanks for joining us. I'm Ken Kirschenbaum, and this is our financial webinar for the alarm industry, presented by Alarm Financial Services, which is Jim Wooster Sr. and Jim Wooster Jr., both of whom you can see on your screen. These guys have been funding the alarm industry for decades, and they're your go-to source if you need money. So the whole point of the webinar, I guess, is when you go into the alarm business or any business, you do have some choices to make. One is, are you satisfied with the status quo, satisfied with the way things are going, or do you constantly have the idea of growth, of doing something more than you're doing, being more successful than you are? I wouldn't want anyone to go overboard on that, because I want you to be happy with what you have. But financing and leveraging what you have is certainly one of the ways to grow your operation. And I think we're going to find out in this webinar series a whole lot about ways to finance your company, ways to treat the financial issues that your company faces. So these two guys know a lot more about it than I do, and I'm happy to turn over the presentation to them right now. And so, guys, you have now been made the presenters, and take over the screen. And oh, everybody, save your questions, type them in, and I'll be reading them to the Woosters right after their presentation. Okay, guys, good luck.
All right, thank you, Ken, and good morning, everybody. First off, Ken, thank you very much for providing this forum. This is a great opportunity for us and obviously for all your readers and today's viewers. So we really appreciate it, and we think it's a great service to the industry. This is, as you mentioned, the first of a series of webinars. So we're going to do today more of a general overview of financing in the industry and how to use lending to grow your business. And then on Thursday of this week, we're going to drill down a little bit and get into the details a little bit more on financing and acquisition. So we'll talk through the different steps and aspects of that undertaking. And then a week from today, on Tuesday, we're going to talk another more drill down, but that one will be about financing organic growth. So obviously, we hope you can join us for those webinars as well. And so if we don't cover something in this one, it's because we're trying to cover kind of a blanket approach here in about 20 minutes. And then be patient, we'll hopefully cover it in the next two webinars. So I want to give you a little bit about our background. We provide financing for recurring monthly revenue based companies, security, fire, PERS companies throughout the United States. And we provide loans and lines of credit from anywhere from $150,000 up to $1.5 million. And we, founded in 1987, we're the industry's oldest funding company. So I'm going to introduce my father, Jim Sr. He can give you a little bit more background.
Good morning, everybody. Thanks for attending. Actually, the 67 number, 1967, was preceded by my entering this wonderful industry in 1967. And I bought a franchise for closed circuit TV, and a couple of years in that, and I was hired as a sales manager of a non-existent sales force in Northeast Ohio. And in 1986, I sold that business to Security Link, Jim Covert and Russ McNadell. And it started out with zero in 69, really not much growth until mid-70s. And then in today's we had about $335,000-$40,000 in today's dollars with our RMR. And a lot of that came from leasing, and I mean selling leases. I mean, we were the lessor. And so we're going to share how that happened. And I'm not trying to be a big shot about that. I'm just telling you that that's the life I live. And so I believe the same fundamentals are in existence and operating today as there was then. Technology, a lot of things have changed, but not the fundamentals. So just to give you an idea of where AFS fits in this financing landscape, Jim?
Yeah, so a lot of you are going to be familiar with different financing methods that occur in our industry. Most notably, I think people are familiar with dealer programs through ADT or Brinks or Monotronics. But there's other different financing methods that you may come across or have experience with or have heard of. New account financing, consumer financing, lease financing, and these are some of the companies that are notable in our industry who provide those services. So what AFS does in comparison is we're really doing loans and lines of credit, really more like a bank that specializes in the alarm industry. You know, I think if you listen to Jim Sr.'s background, what we think of ourselves are as alarm people that got into the financing industry, alarm people that got into financing rather than finance people that got into the alarm industry. So that's kind of our perspective. But, you know, what about a local bank? You know, how do they come into play? Our experience, and when we talk to dealers about their experiences, is that local banks are typically going to be more geared towards lending against receivables, physical assets, computers, furniture, fixtures. They don't understand the value of RMR. They don't understand the economics of how an alarm company works. And that's not something you can fault them for. They can't afford to specialize in every industry out there. So as a result, in order to kind of protect themselves, we'll typically see them setting low borrowing limits or using collateral in the form of personal assets, your real estate, your investment portfolio, things like that. And so as a result, what our industry needs and has is specialty lenders. So here, I've assembled a lot of the players who are the specialty lenders in our industry, some of which you may be familiar with. And so that's what we are. We're a specialty lender. And so, it's funny, I made this slide, I don't know, maybe a year ago. And as I look at it, and as some of you may be aware, a few of the players that are listed on the slide have either exited financing in the industry, financing to our industry, or have significantly curtailed their activity. So it's fluid, and I think so. Certainly, our presence in this space for so long is notable. So since the title of this presentation is how to use lending to grow your business, I want to sort of shift back over to Jim Sr. and talk a little bit about some growth strategies.
Okay, thank you. The fact that we're the oldest in this industry is hopefully tells you that we have been successful. And I used to say it. So I mean, hopefully that gives you a comfort level. Growth through acquisitions is one of the most obvious and one of the most effective ways of growing. There are several benefits. Of course, the RMR increase is a significant one, but I'm going to read some of the others. You get your yard signs are now in an extra several hundred locations. You have service and add-on income opportunity. You take out a competitor. You gain valuable employees. Referrals. If you work it properly, you'll get plenty of referrals. You have new services that you can now bring to your existing customer base that you might not have been comfortable with before, or really realize they were so viable. And vice versa, the company you acquire may bring new services into your income, your profit centers. So there's a list of benefits. You can buy a competitor in your market. You can buy an existing company in a new market. I've done that, actually. I had offices in Northeast Ohio, Western Pennsylvania, and San Diego, of all places. Buy out in a partner parent, some kind of internal transition finance, which I have also done. I've bought out a partner many years ago. So I've done a lot of this stuff, and in future seminars, these will be fleshed out. But anyhow, back to Jim. And we're going to talk a little bit about a straight acquisition at this point.
So again, we're going to drill down in Thursday's seminar more on this particular topic of financing and acquisition. And so our point here today by presenting this slide isn't to get into the details of the numbers or really dissect an acquisition and the steps of an acquisition. It's really to convey a concept here. And the concept is that these are assets in the form of the RMR accounts that you might be looking to buy, and they're assets in the form of RMR accounts that you already own that you can leverage to borrow money. And in borrowing that money, what you're doing is you're coming up with the capital to pay the buyer, right? A lot of times we talk to alarm dealers around the country, and they express a desire to make an acquisition, but they say they can't do it because they don't have the cash on hand. And so this leverage is what gives you the cash, right? So I want to kind of walk through a quick example of how this works in really the most basic sense. So if we talk about, maybe you have an opportunity to buy 300 accounts with an average RMR of $35. So that's $10,500 a month of RMR. And so if you work with us and wanted to try to finance that acquisition, we would talk to you about how those accounts provide cash flow. And we try to work with you and work with the seller to come up with some estimates of what the costs are. So, because what really is most important here is that you're looking at the net cash flow that's coming out of these accounts that you're buying. That's really what tells you, what they're worth. So in our example here, we just assigned a direct cost from the central station and cellular of 20%. Again, in your particular example or your particular situation, that's going to vary. But for the purposes of our example here, what you see is that provides $8,400 of gross profit off of the $10,500 a month of recurring revenue. So let's just say the seller was looking to get, or you're looking to pay, and you arrive at a purchase multiple that you agree on of 32 times. So that would be a purchase price of $336,000. And really what we're trying to convey here is that if you borrowed that $336,000 to buy these accounts, you would have a loan payment of approximately $6,900 on a 5-year loan. So again, the message here is that the cash flow from the accounts that you're acquiring is sufficient to cover the direct costs and cover the loan payment. So what you're really doing is you're using other people's money to make this acquisition. You're using other people's money twice. You're using our money to pay the seller, and then you're using the subscriber's RMR to repay the lender. So this is kind of the formula. This is how it works to finance an acquisition. And so again, we're going to drill down this into much more detail with the various steps on Thursday. But the point is, we want to talk about, this is leverage. This is using leverage to make an acquisition. So we're going to shift a little bit now and talk about organic financing strategies for organic growth.
It's again, as an operating dealer, and by the way, I'm investing in a company right now that is currently an operating alarm company. So it's not like I got out of it in '86 and stayed static. And so these are present day opportunities. You can open a new office. You can roll out some products or services, video leasing, AES, all kinds of different the revenue RMR growing opportunities. You can decide to get not maybe big time, but occasionally as the opportunity occurs in the low down $0 to $99 world. That's negative cash flow, but you have the ability to finance that. Increase your marketing and advertising, hire more sales people and technicians. Those are obvious ones. The one that really I really experienced significantly along with acquisitions was leasing. A guy by the name of Bob Bonitas and I were good friends and operated in Chicago and Northeast Ohio. And he said, "Jim, you got to lease alarms." And I listened to him. So I borrowed money and leased alarms, and that was an incredibly beneficial ingredient in my growth. We'll get into that in detail. Jim and I can actually guide you into that business. And it's like, if you don't do it, if you want to grow, if you're happy where you are, that's wonderful. But if you want to grow, that's just a wonderful opportunity space. The hiring sales and tech sales people, I'll be happy to talk to you individually on that. I have a lot of experience doing it right in the current atmosphere, and I'll be happy to do that. That's a sidebar thing. I'd like to mention one other thing. You might want to sell, and you might not want to sell to one of the biggies because you've got a lot of interest in your customer base, but you have a friendly competitor in your market area that might want to buy, and he doesn't have enough money to buy. You don't want to maybe do a term sale over a period of time. Let us provide the money. So we might be your early retirement plan. Think about that one because it's viable. Okay, Jim.
So again, we're going to, in Tuesday's seminar, we're going to dive deeper into financing organic growth specifically. And so the point of putting the slide up here isn't necessarily to discuss whether, if you roll out AES radio network, you're going to add $20 or $15 or $25, and whether your upfront cost is $300 or $279. The point that we're trying to make is that financing organic growth really means leveraging your assets to tap into capital in the form of line of credit or loans so that you can cover some of the upfront costs that you would otherwise have to put onto your customers. And so by lowering their upfront costs, you absorbing some of those upfront costs, it's going to help you win business, hopefully. And in exchange for that, it's going to give you the opportunity to build RMR. So if you can tap into a line of credit to, the reason I have AES Radio is we worked with a dealer a little while ago who wanted to roll out and replace all of their cell with the commercial cell with AES radios. So they needed capital to buy the equipment up front, to pay the installers, and they wanted to do it for a low upfront for their customers. So they took a look at a line of credit, they figured out what their break even was going to be, and they rolled those out. And so now they're enjoying the additional RMR. And each one of these lines, whether, as Jim Sr. mentioned, giving you the ability to compete with some of the $99 down providers or getting into leasing, this gives you the opportunity to do that. So again, we're going to go into this in a little bit more detail, but really the point is here, if you can leverage some capital, this allows you to hopefully win more business and to increase your RMR. So when we're talking about leveraging capital or leveraging assets, a lot of dealers will talk to us about, well, they'll come to us initially and say, I want to sell some accounts, and that's how I'm going to raise money to do whatever my objective is. And so when we talk to dealers about selling accounts versus borrowing, we'll talk about what are the costs associated with selling versus borrowing. And so a lot of times dealers we talk to will say, what do you mean costs of selling? It's not a cost. I'm going to get money. I'm not going to have costs. But really the way we look at costs associated with selling are the costs that come from not realizing future benefits. When you sell accounts, those future benefits go to the buyer. So there's a lot of expenses or a lot of items that we would consider to be costs in the form of missed future revenue. But also selling accounts is a taxable event. So if you wanted to raise $100,000 or $200,000, you might have to sell you might have to sell $250,000 worth of accounts in order to end up with $200,000, because that's a taxable event. Now, your situation will vary depending on whether you have carry forward losses, et cetera. And you can certainly, you're going to want to talk to an accountant before you get into something like this, but that's a cost of selling. Another cost of selling is the lost future profits from the sold RMR, right? Again, those are going to the buyer. Now, You might also have a situation where you would miss out on referrals, upgrades, or add-ons if you were to sell some of your accounts. Not always. There are some aggregators and buyers in our industry who will allow the seller to continue to do billable service and get upgrades and add-ons and referrals. But certainly if you sell to sort of a local competitor or a big regional company, that might not be the case. So you would be missing out on those benefits. And then obviously later on down the road, during an exit or when you want to sell the entire company, you'll have that. You won't have those accounts that you sold previously to sell. So this is what we're talking about when we say, before selling a block of accounts to raise capital, consider those costs, because we think they're significant. So, well, what would be the costs for borrowing? Well, the cost for borrowing, pretty straightforward: interest and fees. That I think kind of goes without saying. Our experience is that when you take a look at the cost of borrowing versus the cost of selling accounts to raise the same amount of capital, that's a pretty significant difference. What we find is it can be 4 times to 6 times more costly to sell accounts than it would be to do a loan to raise the same amount of money. And we're very confident in these numbers, and we welcome you to contact us afterwards. We'll share them with you. Maybe some of you have gone through loans before, gone through selling accounts before, and we can kind of compare numbers. But this is, in our experience, this is certainly pretty typical. So we're talking about interest related to loans. In anticipation of going into the Q&A here and somebody asking what are our interest rates, we're just going to jump right in and talk to you about that and give you a little interest rate comparison. So AFS, on our deals, we're typically doing loans at around prime plus 6%. So not all of them, it'll vary a little bit by the risk of the loan or the size of the loan, but almost all of our loans are priced in this range. So prime rate right now is at 3.25%. So we're at 9.25%. So I know that from talking to dealers, this can sometimes create a little sticker shock, and especially if you think of interest rates in familiar terms like 30-year mortgage that are going to be pretty low. But this is really a different situation. Our loans are short-term loans. Most industry loans are going to be shorter-term loans. In our case, 4 to 5 years. So the interest rate doesn't have as big a bearing on it as it would on a 30-year mortgage, say, because you got to pay all the principal off in 5 years. So this is a significant amount of principal going to each monthly payment, significant amount of principal reduction with each monthly payment. So consequently, this doesn't have the same impact that it would on a longer term loan. So I think people get a little sticker shock on here, but we still wanted to do a comparison, give you a little perspective on this. So let's throw it into a real life example. And let's say you were going to borrow money in order to make an acquisition. Let's say you were going to buy $5,000 a month of recurring revenue for $150,000. And so you're going to borrow the money to do that. And let's just say you could borrow from us at prime plus 6, or you were able to get the money someplace for prime plus 3, significantly less than that. What we did was we took a look at, well, what would that cash flow be to you, or what would the revenue be to you if you looked over the life of that 5-year loan and you bought that $5,000 a month of recurring revenue? What would and you backed out the interest cost, what would that look like? So, what we found was that if you were to get that $5,000 a month of recurring revenue and you were to finance it at a prime plus 3% loan, it would have generated about $278,000 for you over that 5 years, minus the interest. And at prime plus 6, it would have generated about $262,000. So again, we want to put this in perspective. We don't want to diminish the difference of $15,000. It's significant, but it's not as significant as one might initially assume. So it's certainly not a reason to walk away from making an acquisition, right? Because there's going to be some interest. When you're looking at an acquisition, there are many, many, many costs that go into it, obviously. What multiple are you paying? What attrition rate are you going to incur? what are the central station costs? What are the radio costs? Are you going to have to fulfill service contracts, et cetera? So there's so many costs associated with an acquisition. The interest is just one of those expenses. And, our belief and our experience is that we're able to, but compensate or more than compensate from what you might see as an interest rate differential by what we're bringing to the table with some industry expertise. So, if you're using a loan from us to make an acquisition, you're going to have another set of eyes on that deal, and a set of eyes that have hundreds of deals worth of experience behind them. So we're going to be, kind of giving you our perspective on what we see as you look at making an acquisition, giving you our feedback, our opinion. And, the assets that are being purchased, they're the collateral for the loan. So we have a vested interest in making sure that those assets are sound. So we're going to look at customer payment histories. We're going to estimate what the historic attrition has been. We're going to look at central station signals. We're going to look at the contracts. Again, our background is that of alarm dealer as buyers. So we have that viewpoint, and that's the way we're going to approach a deal. So we feel that unlike just a bank who's maybe providing capital, we're going to provide a lot of other benefits. And we're going to share those results with you as we do the due diligence on the loan looking at the accounts you're going to acquire. We're going to share all that with you. So that's a benefit that we provide that we think is more than makes up for the interest expense associated with the loans. And when we talk about dealers, or we talk to dealers who have financed acquisitions through us, in retrospect, they kind of look back on the deals. Nobody ever talks about the interest rate they paid, right? They always talk about, the success of the accounts that they acquired, what avenues for new services they opened up, how they helped increase the value of the company. So this is why, we're so positive on dealers leveraging loans to make acquisitions and do grow through organic methods. So again, we're going to dive down into more details on those in Thursday's session and the next Tuesday's session. We wanted to really give a general overview today, and certainly leave some time with some opportunity to address some questions. So before we turn it back to Ken for Q&A, I guess I'll just throw it back to Jim Sr. to have him throw in anything I might have missed or any other comments he wants to make.
If a subscriber sent you $1,000 and you kept it on your desk, you never cashed it, that makes sense. If you have the ability to borrow and you're not using it to grow, if you want to grow, that doesn't make any sense. So use our money to grow your business profitably. Ken?
I want to thank both of you. That was a great presentation and a great introductory presentation. I want to raise a few questions that I have, and we'll see some of the questions are starting to come in now. But you mentioned your interest rates. I assume that varies depending on the times. Do you generally require or always require a personal guarantee by the alarm company owners?
We generally do, and that's not untypical. Most banks were lending the kind of money in the same ranges would do the same thing. What we don't do is we don't tap into your personal assets to secure the loan, right? So that is something that banks are more likely to do that we do not do. So I just want to make the distinction between a personal guarantee versus pledging personal assets.
Well, that actually is one of the questions. If you make a loan on a portion of the RMR, do you also require a lien on non-leveraged RMR?
It depends on the size of the loan, as I think the person who's asking the question is alluding to, the idea that you might not need all of the accounts to be the collateral for a loan if it's a smaller loan. And that's certainly something that we've done in the past, and we have to look at it kind of on a deal by deal basis. But the loans the assets are, it's kind of a little bit of a fluid thing. So over the course of a 5-year loan, new accounts come into the picture and some accounts go out of the picture. But what we try to do is make sure that the amount of collateral that we have is in a fair proportion for the size of the loan. So I hope I've answered that. Okay.
Well, not to get overly sophisticated at the moment, but I'm pretty sure I know the answer to this one. You're not making non-recourse loans limited to the collateral that's being purchased. I'm pretty sure you're not doing that.
Correct.
Right? Yeah.
Correct.
So the answer is that, in case anyone didn't understand the dynamic of the response, was yes, you borrow money. They expect a personal guarantee, especially if it's a smaller operation, I'm sure. Maybe ADT, they wouldn't require a personal guarantee, but they also are going to require a lien, and it's probably not going to be limited to just the accounts you bought, and they're going to expect your whole company to stand behind this loan. So I want to comment on leasing versus selling accounts to your customer. And Jim Sr. Raised that issue, and I see he's a big believer in that. And I can tell you that I was brought up originally in the alarm industry in New York City, again from the legal point, not being in the alarm industry. And alarm systems were leased in New York City in the late 70s and 80s. You didn't have sales. Some companies still do leasing exclusively. So the advantage to a lease is that you always own the equipment. You always own that site. The owner of that premises, if he wants to change alarm companies, is going to have to change alarm systems, including the wiring. So there's a big incentive to keep the existing alarm company there. So tenants may move, owners may change. The same alarm company is going to stay there because they've got the lease system. Is it a guarantee? No, of course not. But it's a very clear incentive for a new tenant or a new owner to retain the alarm company because they don't have the cost of a new installation. So that's a very important concept in terms of leasing. The other aspect of leasing is you can, if you structure your deal right, end up getting the same amount of money as you would on a sale. So if you've got a $3,000 sale that you're going to do, you're going to wind up charging $3,000 for the installation of a lease system, and you're going to wind up getting more money on the RMR because you're including a lease in that RMR calculation, and customers are attuned to paying more when they're leasing. They understand that concept. On a commercial level also, the advantage of leasing is that it is deductible to the customer. He can deduct his lease payments each month, whereas an installation that he has to pay for would have to be capitalized over the term of a lease, for example, or depreciated if it's an owner that puts in the system. So there's advantages to leasing as well. And of course, my forms, well, the all-in-ones come in a sale format, and they do come in a leasing format. So you've got that ready for you if you decide to try the leasing or do the leasing. And I think it's a great idea. Next, I want to comment on the sale versus the finance aspect of raising capital for your company. You made a very good point that I honestly hadn't thought about, and that is there's no tax consequence to a refinance. So if you go to borrow on your own base, and you bring in $100,000, there's no tax on that. You're going to pay. You're going to be able to deduct your interest when you pay the loan back. You're not going to be able to deduct the principal when you pay the loan back, but you've got that money, And if you went and you had sold the same amount, you would have had a capital gains tax consequence, and you wouldn't have ended up with the same amount of money. You also would have lost the accounts. You would have lost the customers and all the advantages of having those customers, which I can see AFS places a lot of emphasis on continuing to own your customer base, and it's very important. The next thing I want to comment on is that when you finance a company, the AFS's analysis, when you finance a company, and this is going to end up in a question, guys, is this: you didn't seem to factor in or account for attrition, which we know there's going to be. So when you do the initial calculation and say, well, you're going to buy these accounts, here's your RMR, here's your net RMR, here's what your monthly payment's going to be. And I think in your case, the monthly payment, the RMR was like $6,000, and the monthly payment was somewhat less than that amount. So your comment was, well, you're going to be paying back the loan with the customer's money.
Right.
A great way to move forward in growth, without doubt. The only problem is the old adage, the best laid plans of mice and men. And what happens when the customer base, the RMR revenue, drops below the payment? Because the payment doesn't drop. The payment's constant no matter what, including COVID. So that is a consideration. Now, I'm intrigued by your due diligence, the Wooster's due diligence. You must take that into consideration, because you're certainly not interested in lending to anyone who you think is going to be a credit risk, or you think is not going to be successful. You're closing a deal with an alarm company is your stamp of approval that you think this is going to be a good deal and a successful transaction, and a good reason for making the loan, for borrowing the money, and for moving forward. That's implicit in you guys making a loan. You're not in the business of, and maybe some people are, making loans, waiting for a default, grabbing the accounts. That's not what you're doing. Okay, so you're liable to put some of these guys that do due diligence out of business because you're willing to do it. I wonder how much resource you're willing to put into that effort when someone says, hey, AFS, I'm going to buy $25,000 of RMR, and here's my deal. And I'm going to borrow the money from you. Get to work. So do you guys have an application fee? Do you guys say, no problem, we'll just get to work, and here's your due diligence? And a month later, when you've put in 200 hours, you say, okay, you're good to go. And he says, you know what? I got the money in my pocket. I don't need to borrow from you. So you need, yeah. Go ahead. Okay.
All right. So there's a few topics that you hit on there, Ken. I'll try to get back to each of them, and certainly I'm sure Jim Senior is going to want to comment as well. To the point of your last point, we do have situations where a company will come to us and say, we have the capital, right? However, we don't have the due diligence experience, or we don't have the, our capital provider doesn't have experience. So can you help us through this process? And so we will work with them on what we call, providing acquisition services to help guide them through the process. And they use money that they have maybe through an investor who's got capital. So we can be involved in those opportunities as well. As far as your initial question about the attrition taking a bite out of that RMR, you're 100% right. And when we do the session on Thursday, we will show some analysis where we talk about that diminishing RMR. However, what we hope, and certainly when the dealers that we're working with are making these acquisitions, we kind of take that diminishing RMR into account and still say, okay, does this still cover with an attrition rate in here, are the loan payments still covered? Yes, they are. But what we find most of the time is that the dealers are using these new accounts to get referrals, right? To get opportunities to offer new services, which result in increased RMR. So we certainly at the outset, when a dealer brings us an opportunity, that's one of the things that we help them qualify is, okay, you're buying $10,000 a month of recurring revenue. What do you think about this situation? Is this going to present you an opportunity to take that 10,000 and turn it into 15,000? Or is it going to be 10,000 that becomes 5,000, right? So that's part of the initial work that we do with the dealer. And that's how, and again, we're getting into this a little bit more on Thursday, but this is how we help them figure out how to price the deal, right? Like, all right, is this account base been neglected for a while? Right? So there's a lot of acquisitions happening right now just because of the demographics in the industry. There's a lot of dealers who are reaching retirement age. And what we find is kind of a common theme is, they don't just go from 100% and then they wake up the next day and sell the accounts. We find that a lot of times dealers will kind of sort of back off a little bit, right? And sort of phase out of some of their activity. And so as a result, by the time the dealer's ready to sell their accounts, haven't necessarily had all the latest and greatest services offered to them. And when a buyer comes in, it presents an opportunity to increase RMR. So that's why we think the situation, what we find most often the case is that RMR base either stays the same or grows. And certainly there's attrition, but there's more than enough to offset. As far as the due diligence goes, from being buyers for years and years and years, we basically, our loan due diligence is we go into the situation as if we were buying the accounts. Like we ask all the questions and we look at all the things as if we were going to buy the accounts. We just can't kind of take that hat off and just say, okay, now we're a lender, so we don't care anymore. It's your problem. We still, go into it as if we were buying the account. So Dad, I don't know if you have anything more to add to that.
Yeah, look, I'm a dealer more than a financer. And so I look at everything as I had one account once, one. Okay, so I understand that. I actually installed alarms, which was a disaster. So I look at this as a growth opportunity. The glass is half full. And so when we finance somebody, they're our partner. We have our money in this thing. So we're pretty. I respect to submit that in future seminar, we're going to show you how to do this, including the detail that Jim mentioned, Ken just mentioned, vis-a-vis attrition. Believe me, I wonder if you realize, I'm sure you do, attrition is your expense, period. It isn't your payroll, it isn't your central station fees, not even your attorney fees. Attrition is your #1 expense, and boy, do we focus on that. Thanks.
Let me get to some of the questions, all of the questions actually. So if you ask the question, hang in there, I'm going to ask it. When you do evaluation, is it off the net RMR? Do you minus central station costs, radio costs, etc.?
So one of the first things that we're talking to a dealer about, like very early on in the process of it, so when I think I'm going to assume that the valuation is about accounts that they're looking to buy, but I'll try to answer it both ways, as if you're looking for a valuation on your own accounts. But either way, it's the same answer. And that is we're really focused on the net free cash flow. So what is the profit that's going to the bottom line? If you're trying to evaluate your own company's business, or you're trying to evaluate what to pay when you buy accounts. The focusing on the gross RMR is a little, it misses the point, I think, because you can have 2 account bases, each with 500 accounts. And if one of them is bringing 30% more profit to the bottom line, you're not going to pay the same price for those 2 account bases. So really it's about the net. that we use to determine the value. It's one of the very first conversations that we have when we're talking to dealers and they're looking at an account base to buy. We go very quickly to, okay, how much profit is this going to produce for you? The buyer is buying profit ultimately. That's how they figure out their price. I think we talk about multiples a lot in this industry, but multiples are the way we express the value of RMR, not the way we determine the value of RMR.
Very well said. Keep in mind that the person who asked the question, whether you're going to be paying, you're going to pay on net RMR, but how net is defined is going to depend on the deal you make with the buyer or seller who you're dealing with. And so even though AFS may say, look, this is how we're going to define net for purposes of a loan, that may not be the way that net is defined in a asset purchase deal or when you go to buy the accounts or sell the accounts. So just keep that in mind. There may be some difference there, but clearly as a lender, they're interested in the bottom line. So they're going to net out all expense, and this is what you get to put in your pocket. Okay, right. They're not calculating the tax consequence, though. That's not part of it. But they will take out sales tax. Before we get to some serious questions, somebody wants to know what the map is behind you, Jim Jr.
That's. You know, I don't have the typical bookcase background that a lot of people have in these webinars. That's a nautical chart of San Francisco Bay. So, but which right now is all covered in smoke. So you need that chart to navigate your way through it right now.
It's not the Wooster Empire then. It's just San Francisco. Okay.
The coat of arms, right?
All right. So now we get into the nuts and bolts of a loan. Are there any prepayment penalties, or can you prepay without penalty is the way it should read?
Yeah. So again, these are all things that with any lender, you're going to have trade-off situations, right? So you would maybe do something in exchange. You get a lower interest rate from a lender, but you're going to maybe have a payoff penalty. And if you get rid of the payoff penalty, they're going to maybe come back to you with a little bit higher interest rate to compensate. So these are all things that kind of are levers that are give and take. On our loans, what we do is we have a prepayment fee that goes away after time. So if a 5-year loan, it tiers down. So it starts out at a small amount, then goes down in the second year, down in the third year, and then it goes away, it goes to zero. And what we're trying to do there is really just account for the fact that we have higher front-loaded costs in putting a loan in place. And so as the loan continues, we eventually make our money back. And so at a certain point, we take that prepayment penalty away.
Yeah, I'm gonna take this question out of order.
That isn't good for you, period. So prepayment's part of it. You'll just bring it in your calculations if you don't like it. And if you do, let's go.
Well, and this is a question related. In addition to interest rates, are there any origination fees that are well, basically points? Do you have any points that are paid?
Yeah, we typically do, and this varies a lot with the size of the deal. For us to put a $1 million loan in place, that's not 10 times more work than doing a $100,000 loan. So they're going to maybe be a little bit lower on higher, on larger deals. But yeah, we have origination fees in our deal, like a lot of banks do or a lot of mortgage lenders do. And again, that's something that really varies by the size of the deal typically.
You require your borrowers to pay your legal fees, which, by the way, I get none of. Hope you fix that in the future. But no one actually asked that. I just decided to ask that.
So we have we have standard loan agreements, and so if the dealers go along with those standard agreements, or just modifications that we ourselves can look at and be okay with, then no, we don't charge any legal fees. You know, on the rare occasion that a borrower will really want to tear apart our loan agreements and rewrite the whole things, and we have to, you know, get attorneys involved, then yeah, we would ask them to cover some of those fees. But 90% of the time that doesn't happen, and there are no legal fees in our deals.
This next question is presented by somebody, and it is a very important question. And I'll tell you why it's a very important question, because my experience with bank lending institutions, not an operation like AFS, although we'll find out, but the bank, is there are special reporting requirements that are so onerous that they create traps in the loan. And when there's what I call a technical default, meaning the alarm company hasn't complied with some reporting requirement, as opposed to missing a payment, a financial default, there's a record keeping default perhaps, it triggers increased interest in the loan until ultimately there's a complete failure of the loan, and the loan is called in. So are there any special reporting requirements that AFS requires?
I wouldn't call them special reporting requirements. I mean, the reports that we look at and we ask for from our borrowers are really reports that, I mean, we think should be industry standard reports. So we're going to ask for attrition reports. We're going to ask for you know, how much RMR did you add? How much RMR, you know, canceled? We're going to ask for, you know, to look periodically at financial statements. We're going to look at, you know, AR aging reports. So all those reports, those are not like some esoteric bank measurement that only applies to us. These are reports that our dealers really, you know, should be looking at, and for the most part are already looking at. We just need them to share them with us.
As a lawyer, if this were a trial, I shouldn't ask this question because I don't know the answer, but I suspect I'm going to get the answer that I think you're going to provide. And that is, in any of your loans, have you ever imposed a requirement that the borrower alarm company hire a special accountant, or not accountant, but in-house controller, so that they could comply with all these reporting requirements that you're going to want?
No, we've never gone in and mandated that they do a specific hire.
Okay,
I mean,
good.
if they're having some challenges because they're not used to providing these kind of reports that I mentioned, I mean, we certainly we don't want to just sit there and say, sorry, you know, it's up to you. You got to do these. We want to help them. I mean, one thing that maybe I don't know if anybody believes this or not, but or feels this way or not, but a lender doesn't want to have a default situation. We can't. I mean, we're governed by we have a license with the state of California as a lender's license, and we can't move into a situation and have it become some sort of advantage to us. Like, oh, you were in default and you owed us $100,000, and we're going to take $500,000 worth of accounts, and now we're the beneficiary of that. All we're allowed to do is get our loan paid back and our interest paid back on that. We can't. It can't be to our advantage to sort of seize assets or something like that for our own gain. That would be in violation of our lender's license. So our interest is in our dealers staying in compliance with their loan, doing loans that they can afford to make the payment on. We don't want default situations. That's not good. That's not good for us.
And I'm sure you work with your borrowers when necessary to assist them, and you've got the expertise to assist them, which is a big difference between you and a bank, a lending institution, any of those lending institutions. I can't imagine I would be recommending that they go to any of those other lending institutions. That I just wouldn't. So here's a good question too. How many, and we're almost done. How much interaction does AFS have with an alarm company's end users? I'm going to guess it's none, but let's hear.
We don't, the end users don't know, they don't even know we're in the picture. I think I have an idea why the nature of that question, the background of that question. In some lenders, as a way of getting repaid, they will take over the billing of the customers. So now the customer is seeing a bill from the lender, and that's how the loan's getting repaid. And we don't.
How about lock boxes? Do you require that?
So the way that our loans work is the higher the leverage of the loan, in other words, the higher the amount of the loan in comparison to the amount of RMR that's collateralizing it, the more likely we might be to do something like that. The majority of our loans are a low enough leverage that we don't even have, we don't do a lockbox. What we're doing is we're saying to our dealers, listen, if you want to, here's a loan, here's the loan amount that we can make. If you're willing to do a lockbox, we can make a larger loan to you. That's kind of the way we position it.
Okay. What is the average time from start to finish of a loan? I assume what they mean is the loan process. When they first contact you and say, we're interested, how fast can you guys move?
So what we do is we have a checklist of information that we need to do the loan, and we provide it to the dealer. From the time we get that back, I mean, if it's complete, we can complete that loan in 3 to 4 weeks if we have everything. What we typically find is that's not the reality. I mean, the time is more often determined by the borrower than by us. Like this, we're just sitting here in our offices waiting to do loans. That's all we do. But we're cognizant of the fact that our dealers are also running their day-to-day business, right? So they're kind of doing this with the time that they have. So in reality, if you're going into a loan, I think it's prudent to allow for 4 to 6 weeks or so to be realistic. But a lot of that's determined by the dealer.
Okay, and the last one is, can we get a copy of this presentation? The answer to that is yes. We're recording it. It'll be on my website, Kirschenbaum website, and you guys have the link for that in all the emails. We show you where it is, and it won't be up today, but it'll be up in a few days, and you'll be able to see these two handsome guys and hear their tremendous wisdom that they have. And there's no doubt that there is plenty of that. And we do have a comment. Great seminar. A lot of good information. Well, thank you, and I'm sure I speak on behalf of the Woosters.
Thank you, but if you thought you learned something today, the drill downs are going to come on Tuesday and next, whatever, the Thursday of this week.
17th and the 22nd.
Yeah, so this is, and you know what? I'm an alarm guy. I use this stuff, and man, I made some money, and I'm happy. So join the party.
There you go. There you go. Okay, I want to thank everybody, and we're going to sign off now, and hopefully we'll see you again on the 17th, 2 days from now. And I want to thank the Woosters again. Great webinar, and we'll see you soon, guys.
Thanks,
Signing
Ken.
off now.
Thanks, everybody.
Bye-bye.